Hello and welcome to Virtual Investor Conferences. My name is Phil Carlson, and on behalf of KCSA Strategic Communications, as well as our co-host OTC Markets Group, we're very pleased you have joined us for a fireside chat from SNDL Inc. Before I introduce our speakers, a few points to note. Please submit your questions in the questions box to the left of the slides. If you are interested in scheduling a meeting with SNDL Inc., please click on the Meetings tab found in the left navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome our moderator, Federico Gomes, Vice President, Research Analyst at ATB Capital Markets, and Ryan Hillard, Chief Strategy Officer of SNDL Inc., which trades on the Nasdaq under the symbol SNDL. Welcome, Federico and Ryan.
Thank you. Thanks for the introduction. How are you doing, Ryan?
I'm great. How about yourself?
I'm good, thank you. Maybe just to start off, could you talk a little bit more about your role at SNDL?
Sure. So my role is as the Chief Strategy Officer. I play a multifunctional role where I help lead our integration efforts for all of our M&A, so overseeing the integration planning and how we fit the different pieces together and bring together the different teams. I also work closely with Zach, our CEO, on our M&A planning, any due diligence associated with that, and any additional kind of pre-close planning that goes into it. Additionally, work closely with our business segment presidents on any cross-functional strategic initiatives and objectives, working to help progress those and just supporting where required.
Okay. That clarifies it. So, SNDL has grown significantly in terms of business segments over the past 2 years, and recently you were rebranded as SNDL. So can you provide a brief overview of your business segments and how they all come together and the reason for the rebrand from Sundial Growers to SNDL?
Sure. So at SNDL, we have 4 business segments. We have our traditional cannabis operations. That was really the foundation of the business. We have our cannabis retail that we've acquired and integrated over the last really almost 12 months now. And then we have our liquor retail, which was part of the Alcanna transaction last year. And then our investment segment, which is really being led by the Sunstream Bancorp. Over the last really 2 years since early 2020, we've seen a pretty dramatic change in our business structure. Historically, SNDL was predominantly a B2B cultivator, and that was really the original business strategy and concept. Obviously, that's evolved significantly, and so we felt that a rebrand to SNDL and away from Sundial Growers was more reflective of the regulated cannabis product platform that we've become, rather than simply a cannabis cultivator. SNDL is a much more diversified operation at this point in time, and we felt that a rebrand and moving towards our SNDL ticker, which is perhaps the thing we're most known for, was more reflective of the current state of the business than, say, the historical one.
Yeah, that makes sense. And recently, to that theme of your transformation as a company, recently you announced the acquisition of the Valens company. How does this acquisition fit into your strategy moving forward? And when is it expected to close?
So when we looked at Valens, what we saw with them was really some industry-leading capabilities in Cannabis 2.0, but also procurement and general manufacturing as a whole. And so when we looked at our vertical integration strategy, we really saw it broken into 3 components. You had the downstream, which was the retail, and that was something that we had been focusing on, early in our M&A strategy. We had upstream, which is really around cultivation, which was what our existing, legacy Sundial Growers assets were around. And what we were really missing was that midstream component, which was what we found Valens was really industry leading in, that their ability to take inputs from a variety of sources and turn them into some industry leading products was something of an unparalleled capability that we saw. And it really provided that midstream component of our vertical integration that we were missing.
Okay, and when is it expected to close?
From a closing perspective, we're looking at targeting around mid-January at this point.
Okay. And we've seen some other transactions in the industry in the past among LPs. And we've seen that sort of the industry starting to consolidate. Do you see that continuing, this consolidation movement? And, what can Sundial learn from other transactions in the industry, especially because I think that over the past 2 years, we had some transactions that didn't yield the results that we were expecting. So what can you learn from them and to move forward with Valence?
Yeah, so for the first part of your question, we absolutely see consolidation continuing to happen. We think it's a necessity for the industry. Um, we see this within various stages. We believe smaller companies merging together to try to achieve scale. Some of the mid cap, small cap companies coming together once again, trying to achieve scale and take costs out of their business. When you look at some of the mid and small cap businesses, their public costs are just in some ways even prohibitive. And so, almost out of necessity or a survival tool, we'll see consolidation occurring there. And then we expect to see further consolidation in the larger businesses as well, whether that's a combination of multiple large businesses or them gobbling up, small and medium sized. We think it's just inevitable that consolidation will occur. And, when we look at the cannabis industry in Canada, especially, taking cost out of that industry is really fundamental. We continue to see revenue growth within the industry. We continue to see the industry growing at a top line, but really continuing to struggle with profitability and cash flow. And so integration is almost a necessity to try and take cost out of the business. What we've seen historically is the integrations that have been successful have been ones that have a very clear strategy and goal and objective assigned to them. They were, very strategic, well thought out, and had clear objectives. Where we've seen integrations and acquisition struggle is when it was a bit more of a gut reaction or a reactive acquisition without something that's fully planned. Valuations were chased. And when that happens, it always makes it difficult to have a successful M&A. And so we think moving forward, that's something that we're really focused on, is being disciplined, not chasing valuations, not getting behind, industry momentum, just being very smart in terms of how we acquire, how we merge, and then, really focusing on the integration work after that acquisition to make sure that any synergies are achieved, that operations are brought together, and that the strategic objectives of the acquisition are achieved in the end. And so, really focusing on discipline and execution for us.
Yes. And so when you look at right now, you're one of the biggest liquor and cannabis retailers in Canada. We see significant consolidation in retail as well, with store closures, and some companies divesting from their retail operations. What are your thoughts on the future of cannabis retail specifically, and how much of a part does it play in your long-term strategy?
So we continue to see pressure on cannabis retail in the near term. There is an oversaturation, especially in some of the key provinces, and even within certain areas. So whether it's the GTA, Alberta, Calgary, Edmonton, parts of BC, you really see some heavy retail saturation. And so just by that very nature, we think that there's going to be consolidation. Much in line with what I talked about earlier, some of the smaller players will start to merge as they try to achieve scale and survive the competitive pressures that are coming down. We see the larger operators picking up smaller ones, once again, trying to achieve scale, covering trade areas that they may not be in and looking to round out their trade area strategies. But yeah, definitely see consolidation. And I think we would be naive to think that there's not going to be a significant amount of closures. If we look at like average revenue per store in Alberta, it's probably now below a sustainable threshold. And so by that very nature, you would expect closures to occur as they're just not profitable. When you really look at it, you're looking at it, to some degree based on lease time frames. So, 5-year leases were signed, 10-year leases were signed. The first ones of those, should start coming due in 2023 and the end of 2022. And so I think at that point in time, as organizations can get out from under lease liabilities, unproductive stores will most likely be closed at that point in time. So we definitely see consolidation. When we look at it within the future of SNDL, we really see it as a core component. It's a core piece of our vertical integration strategy. It really is that downstream component. And so we very much see retail playing a core part of SNDL's operations moving forward and for the long term.
Okay. And then right now you have different banners in retail. So Spirit Leaf, you have Value Buds with Nova Cannabis, obviously, and Super Eddy now. So, why own these different retail banners at this point?
What we found is that they target different customer segments, and there really is a place for both, or three, or potentially 4 or 5 banners, and it's really just about targeting different customer segments, deploying different pricing and assortment models based on the demographics, population densities that you're in, competitive saturation in the areas that you're entered, and the trade areas that you're in, and really having a flexible banner strategy, we think, is a way to optimize your profitability. And we see this, and this was an interesting thing that we saw with our liquor acquisition of Alcanna, was that they deployed a multi-banner strategy very effectively. Whether it was the Ace Liquor discounter, which has very strong parallels to the Value Buds model, to a Wine and Beyond, which is really just all driven around assortment and selection, and then to Liquor Depot, which was really built and had a pricing strategy that took advantage of some competitive barriers to entry, whether it was commercial agreements that limited competitive liquor stores in an area, municipal regulations. And so once again, having that flexibility on the liquor side really gave them a competitive advantage. And we felt that the cannabis industry was evolving in a very similar manner, and that having a multi-banner strategy would give us a competitive advantage as well.
Okay, that makes sense. And right now you own 63% of Nova Cannabis, which is a publicly listed company. So why not own 100% of that company?
So there are limits on ownership in some of the key provinces. So if we look at BC or Ontario, BC has an ownership limit of about 20%. Ontario's is 25%. And so we actually see our ownership of Nova coming down as we complete a restructuring of that to come in line with the regulations that have been imposed by the various provinces. And so, moving forward, we would actually see our ownership dropping rather than increasing within Nova as we become compliant with provincial regulations that will allow us to expand into more trade areas and high value areas, especially in a place like BC.
Okay. Moving on to your cultivation side of operations, or the LP side, I should say. So we've seen a lot of product oversupply over recent years, price compression in all LPs. What strategies are you working on to overcome those challenges, and how do you see that shifting in the next year or so?
Yeah, it's a great point. There is that oversaturation continues to occur. We continue to see it. It's interesting within our industries. It's maybe one of the only places in the larger economic view where you continue to see prices going down, not up. So we're in a high inflationary period at a macroeconomic level, and yet continuing to see price compression within cannabis. So that tells you just how bad the oversupply situation is. When we look at it within SNDL, where we've really focused on is right-sizing our operations, getting a better understanding of demand and profitable demand at that, and making sure that our manufacturing, our cultivation has been right-sized towards that. And we think that that's actually one of the key advantages that the vertical integration has provided us. By having, a substantial retail footprint and the data that footprint provides, we believe we've been able to come, much more effective at our supply planning. So truly understanding customer demand, truly understanding distribution, and then being able to pull that all the way back into our cultivation or manufacturing base has allowed us to become much more accurate when it comes to that supply planning. And moving forward, we see that as a continued strategy. Is as you drive vertical integration and as our retail footprint becomes larger, we believe that it will, to a certain degree, normalize the kind of ups and downs of demand that we've historically seen in the industry. And as that normalizes and stabilizes, it goes from a very up and down to something, more boring, more predictable. And we have an internal saying where like, we want to make cannabis boring. And we think that, by right sizing your supply chain and better understanding the pull through vertical integration, it allows us to do that.
And I think that to that point, one of the pillars of your strategy is to increase shelf space for SNDL products, for SNDL products within your own retail network. So can you update us? How's that going? And do you have any concerns in terms of placing SNDL products in other retailers in terms of having some competition there?
Sure. So our share of shelf within our own retail has been increasing really since both the acquisition of Spirit Leaf and of Alcanna in the Value Bud stores there. And so we found it to be very successful and have implemented, a variety of strategies. The retail data that we get has allowed us to do better product planning and product innovation, understand white spaces and portfolio gaps much more effectively, determine where those profitable price bands to be in. And so that's been part of it. Is definitely the insights we've gathered has made us more effective as a product company. Additionally, what we found when we vertically integrated was that part of the challenges with market share was distribution effectively. And it wasn't, getting PODs, it was maintaining them. And so products would come in and out of stock. Sometimes the retailer wouldn't order enough. Sometimes the supplier didn't have enough at the warehouse to supply it. And so in some ways, that's actually where our biggest market share gains have come from. It's just better supply planning, better demand planning. And once again, going back to that is, making cannabis more boring and normalizing the supply chain. So combining those things together have really driven, meaningful gains in our market share within our owned retail. When we look at competitors, there was definitely a competitive reaction, during both transactions. Interestingly enough, one of the first companies that called us after we acquired Spirit Leaf was Alcanna and Value Bud, saying that we weren't welcome in their stores. And then, less than a year later, they were our stores. So there's definitely been a competitive reaction. What we find, though, is that as we get larger and larger and as we achieve that scale and as we can apply competitive pressures as a retailer, it becomes a harder decision to no longer carry popular products, especially if those popular products are moving well through a Spirit Leaf or a Value Buds just down the street. And those are popular products that customers are coming to expect and coming to ask for. And so in the short term, yes, we definitely saw a competitive reaction. But in the long term, as we gain scale and size and can leverage our vertical integration and retail footprint to put brands in front of customers, it's going to become a harder and harder decision. And frankly, if they don't carry our SKUs, then it provides us with an assortment differentiation at a retail level. And so we kind of put our competitive retailers in a tough position in terms of what advantage do they want to give us.
Okay. Moving on to other of your segments, liquor retail. What attracted you to liquor retail, and what role does it play within your broader strategy? And what kind of relationship does it have with the cannabis business?
Sure. So there was three things that really attracted us to liquor. The most obvious was the cash flow. So it was a very mature business, had historically generated meaningful cash flow for 20, 30 years. It was much more stabilized. And we felt that it was an effective deployment of capital to get that revenue and profitable foundation that could then help us weather and normalize the ups and downs of the cannabis industry. And so that cash flow and profitability and just the general maturity of the industry was something very much of interest to us. When we look at, some of the other ones is their corporate services. So once again, a very mature business and one that had very strong capabilities in the back office, whether that was the business technology that was underpinning their retail operations, their HR team that was, continually growing and resourcing and staffing, 200 stores, several thousand employees. And then even a finance team that over the last 20 years have put together very rigorous financial cash management practices. So that whole back office was very sophisticated. And we felt, especially when we looked at cannabis, it was best in class. And outperformed really any of the peers that were solely focused on cannabis retail at that point in time. And then the third one was that we saw a lot of similarities between liquor and cannabis in its evolution. And so by having liquor, we could really start to see how that industry had evolved. It's a regulated product. The supplier is basically the exact same in Alberta, the AGLC regulating and supplying both industries. We found very strong similarities between the real estate and trade areas. Where one of our liquor stores was successful, it was very likely that our cannabis store was going to be successful. And so we saw very strong similarities between liquor and cannabis, and felt that having a better understanding of how liquor had evolved and what was successful there would give us a competitive advantage in growing and maturing our cannabis retail. Because there was an interesting saying at Alcanna before we acquired them that a store was a store was a store. It didn't matter what it sold. It didn't matter what industry it was in. It operated and managed very, very similarly. And that thesis and that mentality, we saw real value in.
Okay, and cannabis is obviously a high growth segment, and as you mentioned, liquor retail is a bit more mature. So how do you look at growth in liquor retail, and from a capital allocation perspective? Does Sundial plan to allocate more capital to that segment?
Yeah, so we think there are growth opportunities within it. Alcanna was in our liquor retail is very focused on Alberta. So we're continue to assess expansion. Our Wine and Beyond store in Kelowna is doing very well. So we continue to look at that province as there potential expansion opportunities there, looking at Saskatchewan and the Prairie provinces for further expansion. We're just assessing it, like you said, within capital allocations. So at this point in time, where can we see the best return on our capital as we look to deploy that, and where are those opportunities? Additionally, when we look at the liquor retail, we think there's some real opportunities for growth that don't require a ton of capital. So we have a very extensive retail footprint. We have a large number of customers that are entering our stores every single day. And so expansion into other areas like e-commerce, we think there's a real opportunity there. We've seen some very early success and some good success that required minimal capital allocation. When we rolled out some of the direct-to-consumer strategies, notably Skip the Dishes, has been a really good option for us. And so we think that there's a way to grow the liquor business without necessarily expanding upon its retail footprint.
Okay, and sticking to that theme of capital allocation, just talking about some M&A. So you've been pretty active over the past few years. What's your M&A strategy moving forward?
It's continued to be built around a vertical integration. And what we've also looked at when we look at M&A is focusing on capability. So if you look at Valence, for example, that was our big focus. We spent more effort on what their capability was than necessarily what was their commercial outcomes, because we were really missing that capability in the midstream. And so that was a key focus for us. And so as we look forward to additional M&A in the future, it's going to be very much along those same lines, supporting and enabling our vertical integration strategy. What capabilities can we acquire that enhances either, the midstream, upstream, or downstream aspects of that vertical integration? And how can any capabilities either allow us to achieve greater market share within our own stores, achieve greater market share elsewhere, expand our retail footprint, whatever it may be. And so that's, continuing down that vertical integration strategy is going to be key. If I had to say in the short term, what our M&A strategy is going to be, is it's going to be a focus on integrating Valence successfully. That's going to be a key thing for us. We want to do that well. We want to show strong integration, achieve the synergies that we've targeted, achieve the supply chain rationalization that we're focusing on. And so, if I had to say in the near term, our M&A strategy is going to be making the Valence acquisition successful.
Okay. So we have about 5 minutes, so I'll just move on to some questions from the audience. I think one question here is about interests or efforts that you have to start groundwork for U.S. entry in cannabis or liquor. Any comments on the outlook there?
Yeah, when we look at the U.S., our focus has really been on the SunStream Bancorp, and that has been our entry into the U.S. market. It gives us exposure to that U.S. market in a way that's not plant touching. It allows us to see how the various states are evolving from a regulatory competitive saturation perspective. And we believe that that's where our focus will continue to be on, is continuing to enter the U.S. through our SunStream Bancorp, get exposure to the U.S. through that. And then as the regulatory and legal situation evolves, we believe that our investments through that vehicle gives us a lot of optionality for future expansion if it becomes available. In the meantime, what it provides us with is, good cash flow, good exposure, and good insights into how the industry is evolving. So we think it's the most effective way that we can enter the U.S. at this point in time, and gives us good optionality for future expansion when the regulatory environment allows for it.
Okay. Another question here is on the status on the stalking horse bid, and will SNDL do share buybacks?
So when we look at the stalking horse bid for Cannabis, our bid has been accepted by the court, and at this point in time, we're just working through closing, and we'll share updates as that moves forward. So, moving just into the final stages of the CCAA process here in Canada. And then when we look at the share buybacks, we've conducted some share buybacks in Q2 2022. We still have, capital allocated for that program. We're just being very, conservative and very due diligent and appropriate with our capital as we look to make sure that we're allocating it in the best ways possible. And so really just continue to monitor the situation as we move forward.
Okay. And what is the current status of the Novo share distribution to SNDL shareholders?
So right now we're working through the restructuring that we need to achieve that. And as we get closer, we'll continue to share updates with our investors. But we believe we've made some meaningful progress on towards that restructuring.
Okay. About your cannabis cultivation segment, how much is it expected to grow this year?
When we look at growth, our main target when we look at that segment is how can we become operationally cash flow positive. That's really what our push is towards. So there's definitely some growth targets within that, but also what we're really focusing on is just profitability. Growing top line revenue for the sake of top line revenue is not something we're interested in doing. We're focusing on how can we grow that business profitably? How can we change that business to become more profitably? And a lot will change and adapt as we bring the Valens acquisition to close. As that will have a pretty profound change on our business, allow us to really grow and extend into the Cannabis 2.0 areas. And so what I would say is that we'll continue to see an evolution and pretty significant changes, but all underpinned by a focus on profitability and a push towards operational free cash flow.
Okay. And then in terms of your cannabis retail segment, do you have any goal in terms of the number of stores that you want to have open?
I don't think we have a fixed goal in mind. It's not like we're saying, we're going to get to 400 doors. We don't have that in mind. What we do have is, continued growth. We think that the build-buy dynamic has swung towards a buy proposition. Where at this point in time, it's actually cheaper to acquire a store and convert it than it is to build one out. And so we think that our strategy, which has been very much, say, in the first 3 years of cannabis retail, was very much around building as fast as you can. We see that shifting into more of an acquisition one, as that build-buy proposition has definitely changed. And so that's where we see growth occurring, is through that. We'll focus on some of the regions where we don't have as great a trade area exposure. So the prairies, BC, parts of Ontario. But once again, changing into more of a buy acquisition, whether that's, successful chain, struggling locations, we believe there's an opportunity to, be smart about and be opportunistic as we expand moving forward.
Okay. So we have about 40 seconds left. What should SNDL investors expect in 2023, and any parting words that you might have?
I think just to a certain degree more of the same as 2022. A real focus on profitability is what we're pushing for. Continued push into vertical integration as we rationalize our retail and bring together retail banners, and as we integrate Valens and close that transaction. and as we reassess and right-size our cultivation approach. And so I would say just more of what we've done in 2022. We're not seeing a dramatic change in our strategy. We're really just focusing on that execution of vertical integration and a constant march towards profitability.
Okay. Thank you, Ryan, and thank you everyone that's watching.